So, Allison, thank you very much for joining me. For people who will be watching this on YouTube later and people watching it today, right now, you are Allison Taylor, CEO and co-founder of Invico. You're a registered portfolio manager. You have an MBA in finance, an honors BA in actuarial sciences and statistics. You have previously worked at Mercer Management, Towers Perrin, RBC in the merger and arbitrage division, Ernst & Young, and that was all before you co-founded Invico with Jason. Isn't that right?
That's right.
That's good. Well, I'm glad that you could join us today. Typically, when we have a portfolio manager on, you sort of start with the process and work your way down to the performance to sort of highlight how these things work. But I want to actually start with the performance today because I think it might be more illuminating about what it is that you do and why it's unique. Because the lending rates right now are very, very low. And you really can't invest in loans at any substantial rate. Yet the returns on the Invico diversified portfolio are around 10% on average. And I think your internal yield on loans is up at 14. So walk me through, how is it that we get really high returns on the investments, and what kind of risk is someone taking when they're investing their money this way?
Yeah, that's a really good question, Adrian. So for us, obviously there's a balance between risk mitigation as well as return. I think the short answer, and I will obviously expand on it, but at the end of the day, we are lending into unique situations, and we are in the private space, which is a very illiquid space for investments in general, and you get paid for illiquidity. So as it relates to the lending side of the portfolio, these are groups that can't get traditional bank lending. And it could be for a various variety of reasons. Sometimes they could get bank financing, but the time to completion is not fitting their time frame. So that could be one situation, which is obviously those are the I guess I would say the creme de the creme, because those are situations that a bank would do, except unfortunately a bank may not be able to move quickly enough. So those would be one category. Other ones would be dealing with groups that may have something that doesn't fit quite inside the box of the bank. And so, for example, on the oil and gas side, this could be groups that don't have their updated reserve report yet per se, but we have the internal expertise to do that analysis that we don't need to have that signed off report in order to check a box. So that would be an example. The other thing that we've been able to do successfully for groups as well is help them tranche out their debt needs. So that could be circumstances where a group comes to us and they say, hey, they may go to a bank and say, I'd like to raise 20 million. A bank looks at it from a very narrow focus and says, you know what, we can't lend you 20 million right now. We may look at it and say, hey, listen, guys, it's great that you want 20 million, but based on your current financial situation, we can only see ourselves advancing 10 million, for example. Accomplish X, Y, and Z, and we'll give you the next 10 million. So we're set up that we can, manage those types of processes internally. So that's a big part of what we do as well, is working with groups to really fit what they need into our portfolio. Doesn't always work, but there are lots of circumstances where we are able to capture those unique needs of different borrowers.
Can you give me an example of maybe someone that would normally come to you looking for financing that you turned down, and why would you have turned them down?
So one of the quick, I guess, pro-cos for us is we don't do startups. So if somebody comes to us with without a track record, that's a startup, that's just a full stop. That's not going to work for us. Then there are situations where we look at their track record. Sometimes we see files 3 or 4 times, and it's always fun to go back to those files and say, well, I passed on it the first time, and actually now this is the 4th time I'm seeing it, I'm still passing on it. So typically there'll be situations where the management team is not a proven management team. They don't have, in our view, the expertise, or many times, more often than not, we always do stress testing, and a lot of times their forecasts are just not reasonable. We don't feel that their forecasts are going to be achievable. And so those would be instances where we do stress testing and say, listen, obviously if you don't meet your forecast, the metrics aren't going to work for us. So as a result, we just can't lend into this situation.
So it doesn't sound then like if they have to come to you in some kind of fully finished model, because you'll work with them to help them achieve goals, but you're not going to work with them to bring them to a state that they would be worthwhile to lend to.
That's right. Yeah, for us, that doesn't fit our profile. That's more of a venture capitalist or venture debt type of structure. We need to have these are seasoned companies that need to be operating, need to have operating cash flow and consistent operating cash flow historically, or they could be asset rich. They may not have the cash flow, but obviously in that circumstance, there's adequate leverage that we can, security we can take against their assets, so that if things don't work out, we can obviously step in, take possession of the assets, and go from there.
Obviously, I mean, when you start talking about debt with a regular person on the street, not some weirdo like myself, the idea of debt looms in people's minds. It seems risky. Now, obviously, there's lots of places in life where we assume debt quite casually. There's credit cards, mortgages for houses. Those things don't seem risky. We do them with almost no second thought. But the concern is when we get into this private debt space, as you point out, it can be quite illiquid. These are businesses that have been passed over by major banks. So the concern is always what happens when these guys default. And you said, well, you're interested in risk mitigation. What does risk mitigation look like? And then I'm going to press you a little bit on sort of when it doesn't work out.
Yeah, no, absolutely. So from our perspective, when we're looking at underwriting a facility, we're looking at different metrics, and those metrics would be candidly different than the bank metrics, not always different. So I think the challenge is for the bank, they have a set of metrics, and if you don't meet every single one of those metrics, then you can't borrow money at 3, 4, 5, 6%, which is fine. That creates an opportunity for us in the market as well. So from our perspective, there are obviously a set of metrics that we analyze and that we have to follow. However, we may have a little bit more flexibility. So, for example, we may have a debt to cash flow coverage ratio that we need people to meet. But for example, we may be bridging them through to an acquisition. We look at the acquisition and we say, okay, today you may not meet that, but once you complete your acquisition with the capital that we're going to lend you, and you basically roll that into your operations, we believe you'll meet that metric. So we may give them a temporary holiday in order to meet that metric. The banks wouldn't do that. Like if you don't meet it right out of the gate, typically, the banks won't do that. So that would be an example where we feel that's a risk that we're willing to take because we've done our analysis, we've done our homework on the management team, and we feel it's an achievable metric that can be met. So that would give you an example of a risk mitigation standpoint. On the flip side, obviously, when we're looking at that, we're obviously looking at how much if they have assets that we can collateralize against. We're looking at, okay, worst case scenario, if things don't work out, what kind of assets are there that we can step in and take security so that we can work our way through the situation. So we always have different bells and whistles. And I think the other thing that is important to kind of point out, Adrian, is that we're not basically a every size fits all, right? Which I think is also a challenge when you're a large organization like a bank, which I totally understand. They feel their need in the market too. They can't be flexible around their metrics because they're doing a lot of loans, and they have different parameters that they can't be flexible whatsoever on because they just can't do that. So that's an example of where we would be able to potentially give somebody that 3-month or whether it's 6-month holiday to reach that acquisition metric that they once their integration is complete, that we would view as a prudent risk to take, but you do get paid for taking those types of risks.
Okay. Again, I'm going to press you a little farther on that, but just let's ask an obvious question. Why is it the banks don't want to do this? I mean, the banks are, in Canadian terms, I mean, I saw someone once say that Canada's really 5 banks in a trench coat, but it does feel like our banks are all encompassing. They're extremely large. They have a lot of different lines of business. And yet it seems impressive to me that, there are private mortgage providers out there. There are companies like Invico where you guys are getting away off, charging really substantial sums for a little, I'm not going to say maybe not a little extra math, but some extra math of, and they won't do that. Why is that? Why wouldn't like a TD or an RBC be interested in financing some of these deals given the rewards that come with it?
You know what, Adrian, you raise a good point. There are times that we do, for example, I can give you, it's not that they're not interested. Sometimes they do the transactions, and sometimes we do lose out from a bank. So I don't want to say it never happens. I actually had one recently. I was actually really surprised that the bank stepped up to do it. So they do sometimes do it. A lot of times, the challenge will be the client may not be part of it. They may not be dealing with the right individual in the bank. So if these are groups and banks, investment committees are very centrally located as well. So the challenge is they may be dealing with a branch manager in a regional location that may not have the wherewithal to be their advocate into the higher levels of the bank. So that could be part of the challenge. Part of it could be back to your kind of point earlier about packaging. So, for us, obviously, we need to have a financial model that a client provides to us to be able to perform our analysis. But sometimes, they aren't necessarily the best financial models I've ever seen when they come in. And I think the challenge is obviously if those come into the bank, depending on where they come in and who they come into in the bank, they're not necessarily going to roll up the sleeves and do some additional work or push that client to go back and really, develop the model to the level that it needs to be developed for them. That could be part of the circumstances. The other circumstance, as I mentioned to you, could be time, because one of the other things, and it's just unfortunately a result of being set up as they are, banks are very sequential in the way that they perform their analysis. So what will happen is the branch manager might be like, okay, I'll pass this on to somebody in the credit department. They're working on it, and then it goes to the next level. They've already spent a bunch of work. Time has passed, and I hear time and time again from clients, wow, I was working with bank XYZ for 6 months, and I thought I was going to get it done. And then all of a sudden it was like, no, we're not going to do this transaction for whatever reason. And now I'm in a jam. Like I got to close this acquisition, or I need to buy this equipment, or whatever the circumstances are. So I think more times than not, a client would prefer a quick no than a long drawn out no. Right. So I think that's part of the challenge. And what we do internally is we actually have an investment committee meeting every single week. And these opportunities are brought forward to the broader team, and that's not what they typically do at the bank. So we can look at an opportunity and say to the team, is this something we want to pursue further? We can kill it right away. It's a quick no, this just doesn't fit our space, or yeah, this is worth pursuing. And so I think that is also helpful in the way that we organize ourselves to look at deals, so that way it's not like it's somebody in a lower rank looking at it and then comes to investment committee and the portfolio managers say, oh, this just isn't going to work. And the clients put a bunch of work into it. So I think that's also part of the beneficial way that we operate in terms of being able to look at opportunities and giving quick no's. We don't give, we give fairly quick yeses relative to the bank, but obviously sometimes our clients think it's still too long, right? But I mean, at the end of the day, you got to be prudent and do your underlying work for sure too, as well.
I happen to know a few years ago, you had a couple of defaults in 1 year, which is not unexpected given that you do a lot of loans. The one I'm thinking of is probably the one I was most familiar with in conversation. It was a oil and gas company. I think they were located in Texas, but had an operation in Calgary. Does that sound right to you?
Yeah. So it's actually a services company. So on the oil and gas side, you have the production side, and then on the services side. So yeah, this was a services company that was a Canadian-based entity that had a U.S. subsidiary. Okay. And so they were, when we did a loan to them, and that's going back quite a few years now, Adrian, as you mentioned, they were doing what's referred to as directional drilling. And so they had directional drilling kits that they were basically putting out to work in the service space, both on the Canadian side and the US side of the border. And that was a loan that we have facilitated to the Canadian entity with the US subsidiary. And that was a circumstance, unfortunately, a combination of both, obviously, a demise in the commodity pricing that resulted in a tremendous halt to the industry back in 2015, as well as a management team that couldn't, pivot to be able to service the loan. And that was an instance where we were in the first security position. There was a lot of equity that was raised. So back to your kind of question and kind of tying in, why would you want to be on the debt side of the balance sheet? That's an example of why. Because in that instance, if you're on the equity side of the balance sheet, that all got basically written down to zero, but because we had the debt, we were in a first security position, we had security of both the assets and the underlying shares of the entity. So as a result, we were able to exercise our security, step in, and basically decide where we were going to go to from there. So I think the challenge, as you mentioned, is consumers in general, and I think it's a reality of the media, debt is scary, right? But from a investment fund perspective, that was an example of why debt is a good thing, because we were obviously at the front of the bus, if you want to look at it that way. To back to your earlier comment about putting in layman terms, obviously we were the first person to be able to come in and take control of the situation, and which is exactly what we did. And unfortunately, nobody ever wants to fire themselves either. That's the reality, especially when they're getting paid a paycheck. So we had to make some tough decisions. We had to move quickly. We exited the entire Canadian management team, and the only performing part of that company at that point in time was the US based management team, which we then aligned ourselves with, incentivized them obviously to be wanting to move things forward with us. And we also were able to work with them to pivot and basically expand the market offering, not just to do directional drilling, but also to the tool rental space, which at the time was obviously a much better route to go. There was a lot more customers looking for that service. The overall cost of structuring it was much lower. And so as a result, we did take our security pivot into that situation. And that company was very successful and very strong. Obviously, with the latest COVID turn, we have had a dip in performance there in terms of utilization. But once again, that management team through the COVID situation was able to cut costs very quickly and significantly. And now we're back and moving in the right direction for sure. Obviously, things are starting to turn. The tool count is the highest on the rental side that it's been since pre-COVID. Just recently, I actually got an email yesterday from the president in terms of the tool count continues to rise. And I think now with hopefully the pandemic moving behind us in the rearview mirror, the demand is going to be increasing as well, which is obviously, it can be seen already in the return to commodity pricing as well.
So the things I would take away from that, and I would direct people to pay attention to, is first of all, there's a real nuts and bolts aspect to what you're doing, right? That you got into the muck with about that business. It wasn't just we've lent here and we're hoping things work out. The other one is though that you were securitized. You had enough. If you turned around and sold the assets that were there, the actual tools, the directional drilling capability. My recollection is that you probably could have recovered the loan that had been made, but instead you actually rehabilitated the company and therefore the loan as well. So the loan is ongoing and it continues to provide income to the portfolio. Would that be a fair summary?
That's a fair summary, Adrian. I think that is a couple of the points that you touched on, and maybe I'll just elaborate on, was that active management is a key part of what we do as well. So we've built our team out, which is really important. That there are times when circumstances might not be in a position. And going back to 2015, we did have a strong collateralization. However, at the time, commodity dropped significantly. It wouldn't have been the time in the marketplace where we wanted to liquidate that equipment, because there was a tremendous surplus of equipment in the market. So whenever we're underwriting, for example, energy services loan, not to get too technical, but there's different metrics that you can use. And I always use the analogy, Adrian, if you had let's just pick a nice car, not in a crazy car, but if you had yourself a nice, Mercedes SUV, okay, let's not go too high end, and you needed to sell that car, if I said you're saying, I need some cash, I need to sell my car. Obviously, the price that you could get for that car would be different if you said, well, I've got till the end of June to sell it versus, Adrian, you got to liquidate that thing by the end of the day today or the end of the week. Obviously, there's different metrics that you use in terms of forced and orderly liquidation. So at the end of the day, we're always conservative in the way that we allocate, I guess, the amount of loan against the assets, but timing is everything. So you don't want to be liquidating your assets at the bottom of the market, which is something. That's why we made the decision that you're right. We could have got out of the loan at that point in time, but we didn't think it was the most prudent time to exit the strategy, which is why we do have the capabilities internally to actively manage and the proper structures. Myself and my business partner have run private equity funds, so we understand how to align the management team to incentivize them as well. So that's really important, because typically when you liquidate things quickly, the only people that benefit in those instances are either the auction houses that are getting paid to liquidate the equipment, or the receivers or lawyers and accountants that have come in to run the process. So we have a bit of a different strategy when we're looking to work our way through a situation that didn't work out. We don't throw the keys to the receiver and say liquidate and get whatever you can, because obviously depending on the market conditions, it may not be the best time to do that. So that's our kind of focus, is that we are willing to roll up our sleeves and get active to manage out these situations.
Okay. How many loans does the fund have at the moment? What can you say?
21.
20, 21. And they're in different sectors. And I want to touch on this right now. I just want to go into some of the sectors. I want you to actually start with me about the enduring interest in Nicolas Cage, because for whatever reason, more terrible movies that feature Nicolas Cage seem to have Invico attached to it. Can you explain Invico's movie investment wing that you guys do?
Yeah, absolutely. You know what, Adrian, just for the record, we've only actually been involved with one Nicolas Cage movie.
It's 100% too many, but it's okay.
You know what? There's actually a whole segment of the market that are massive Nicolas Cage fans, because a few years ago, back obviously pre-COVID, when you could go to these types of functions, you can in the US now, by the way, again, but there was an award ceremony where Nicolas Cage got recognized for his accolades in the industry. You probably would have puked if you were there based on your comments about Nicolas Cage. But I have to say that I was actually really shocked about the number of groupies he actually had that attended this award ceremony. And the name of escapes me right now what the award that he was that won. But there's a whole segment of the market that loved him. He's actually a very interesting cat. But
all I'm going to say about this is I think there is a different person that won an Oscar for Leaving Las Vegas than there is the guy who does the Saskatchewan filmed post-apocalyptic dystopian movie that you guys were financing. So anyhow, forgetting Nicolas Cage.
Fair enough.
What is the movie? Why are movies something that you finance? And how does that work? Why is that an interesting part for you guys, man? Because it's been a progression, and I think it's now 5 to 10% of the portfolio. Would that be fair?
That's fair. Yeah. And so actually we so the example recently, so I'll just walk you through. It's always easier to use an example, I think, than to talk about something in a non, I guess, concrete manner. Well, interestingly enough, the most recent movie production that we did was actually a movie that was filmed during COVID. And I kind of highlight that because obviously this pandemic has been disruptive to many industries. And in particular, film was one that was very hard hit, which was interesting because I would argue that demand, obviously, film picked up during that time. Maybe not necessarily obviously in a movie theater, but in terms of people, sitting around at home, locked in their houses and had enough of their family and needed something to do, they were streaming a lot of movies. And unfortunately for the movie industry, that was a space where they could not produce any movies because of the restrictions and the lockdowns in various jurisdictions. So we actually worked with a producer, the same producer actually that had done the Nicolas Cage movie that you cited. And he actually is a Canadian-based producer. And I think also people always think producer means director. And obviously the producer of a movie, and I wasn't really obviously I guess aware of this prior to getting involved in the industry. A producer of a movie is really the business manager of a movie, and they go around and try to figure out how they're going to finance the movie and they get the talent, obviously, and the script and the director, but they're kind of like the CEO of the movie, for lack of a better description. And I think that what people don't really recognize and realize is all the work that goes into a movie that they just show up at the theater and back in the day, or now they stream on their television. And really the big thing is on the financing side, and obviously during COVID, was how are we going to get this movie done with the constraints and restrictions that we have. And so for us, the way that we get involved in a movie production is really twofold. We can either finance the tax credits. So once again, the Canadian government, depending on the jurisdiction, there's provincial incentives as well as federal incentives that movie producers can access to help them produce a film. Unfortunately, they can't access them until the movie's done, which is great. But the problem is somehow they got to pay the bills along the way. So it's really arguably a long dated receivable from the Canadian government that, if you do X, Y, and Z, and I'm simplifying and do a lot of government forms, and you put that in and you meet certain criteria, one of them being you finish the movie, you'll get the tax credits as long as you check all the boxes of the criteria. And so that's one area of film that we do play a role in, is lending against those tax receivables. The banks do that too. And there are some, in particular, National Bank is a big provider of that type of financing. However, one of the challenges, once again, with the banks is they do charge quite a few fees on a flat fee basis and numerous other fees that may or may not be the right choice for a producer when they're looking at a smaller budget film. It obviously works in a very large budget film. So that's one area that we can play on the film space. The other area that we can play, which once again, before I got involved in film, and I think a lot of people don't necessarily realize, is that every jurisdiction in the world has a different bucket, I guess, in terms of selling. And what I mean by that is basically the movie we just completed in the fall with under the COVID restrictions is a movie by the name of Dangerous, featuring Scott Eastwood and Mel Gibson. And that movie is sold in the US, it's sold in Germany, it's sold in France, it's sold in Japan. And so there are all the different jurisdictions around the world buy that movie. And those are what we call pre-sales. So they basically execute contracts. So in the instance of the one that we just completed, the Dangerous one, Lionsgate actually bought the North American rights to that film. So they have said, you know, for the rights to be able to distribute this film in North America, we'll pay X amount of dollars. But once again, they've signed a contract, but they won't actually pay the money until the movie's produced and in their hands. I'm simplifying obviously a little bit, but basically once it's delivered to them, they'll then write the check. So we'll obviously finance it against that as well. And there are other groups obviously that will do that, but that's an example of another side of the film space that we can play a part in. So in this instance, they also sold the jurisdictions internationally, different groups throughout the world. Before COVID, we also used to sell the movies. They sell the movies to the airlines. They sell the music rights if it's a very musical portion of a film. So there's various different areas of the film that you can securitize against. So it's a very interesting space. But there is a lot of paperwork that goes into that space and a lot of work, obviously, by the producer kind of managing all the parts of the film space.
So I happen to know someone who works in the film business, and they work in the accounting department of the film business. And, you know, they must be your best friend, because when they walk me through what they do, what they're really doing is making sure that things have been filed exactly correctly so that they can maximize those tax returns from the Canadian government. Are most of the films that you're financing, are they here as what's happening, or?
Yeah, all the films that we have financed have been produced on Canadian soil.
Okay, that's amazing. Thank you.
I should say, with the caveat of the Dangerous one, Mel Gibson wasn't willing to come up in quarantine. So he did his.
Mel Gibson is a difficult person to work with. I am shocked to learn this in 2021.
So Mel actually, it was the first time that I'm aware of this, at least that we've been involved in, and this was kind of like the COVID planning. They actually shot his portion of the film in LA on site there in a separate portion. And then the Scott Eastwood came to Canada, quarantined, and then the balance of the film was completed in Canada. So it was a really unique, obviously COVID required this ability, which obviously has in many industries, to be creative. So it was a very unique way of being able to go about it, and I don't know, and I've never been involved in a film where they've done that before, where, you know, I've seen portions of films be shot in different areas, but not necessarily where an actor or actress obviously is just in that US location. And then we were able to do the portion in Canada. So that was very unique.
Sounds like you're getting a Skype call.
Oh, sorry about that.
Okay. In addition to the movie loans, you also have something called factoring. Can you walk me, because we're starting to, I realize we're whittling down our time, but I appreciate that you're giving us a good walkthrough here. What is factoring? Can you explain it really quickly about what it is that you guys do and how it adds to the portfolio?
Yeah, no, absolutely. So factoring is really people that are, so typically the way factoring works is it's a small company doing work for a major, in our instance of how we participate in it. And there's obviously various, I guess, areas in the world where factoring is used. It actually started in Montreal in the garment industry, which is kind of an interesting little tidbit. But the way that we are participating in the factoring space is in Western Canada, we have a lot of small services companies doing work for major oil and gas companies. So they do work, for example, we have a client that's a welding company. They do work for major oil and gas companies like Tourmaline, for example. And basically Tourmaline, they have to do the work and they have to pay their employees every kind of 2 weeks. Obviously, most people want to get paid to come to work and they want to get paid every 2 weeks. Unfortunately, they obviously bill their work back to the oil and gas company, and the oil and gas company may not pay them for 30, 60, 90 days. companies. So as a result, they kind of need some way to bridge that that need for financing. So they basically come to us and they say, listen, I've got this receivable from oil and gas company XYZ, or in this instance, Tourmaline. Will you advance against that to me? So we basically lend them the money, and now the oil and gas company pays us directly. So I'm very much simplifying it, but it's a type of lending arrangement, Adrian, but it's very short term in nature. It's very administratively intensive, but can be very diversified and very and very well, I guess, securitized, in that we take the way that we operate in this space is we have what we call lockbox account. So we actually make the client pay into our bank account. And then obviously if there's any residual after fees, we remit back the balance, because we never advance 100% against a receivable. Okay. We always as well.
I'm curious, does that factoring sounds in some ways substantially different from a traditional loan that you're doing? Do you count the factoring in the 21 loans that you have?
No, that would be separate outside.
That would be separate. Okay. So then we've got factoring as one component. We have a private debt component, which consists of 21 loans. They include things like corporate lending, bridge financing, and things like the movie development. I want to come to the last thing, which is your energy working interests, is how you tend to put it when you're in your press stuff or when you're talking about it. I'm a pretty green kind of person in some level, but I tend to have a much rosier view of, say, our oil and gas country. But in the media, we get a lot of very negative press, or at least the future, we're all going to be driving electric cars in the next 5 years, which doesn't necessarily strike me as true. You have not, as you point out, not loans in this space so much. You have an actual equity position in this space. Why would you have that? And what do you think is the view of oil and gas? Why would you want to have exposure in an industry that is supposedly dying at the very least?
Yeah, I was going to say, I don't know if people would run around the streets of Calgary saying it's dying, because I think the reality of it is, I think obviously there's a lot of alternative energy sources coming on market, but I don't think that's going to happen overnight by any stretch. I would argue that gas is a bit of a transitional fuel. Obviously, I know in Eastern Canada, there's a lot of nuclear power plants, but obviously when you have your electric car, somehow you have to generate electricity to charge up that car. And a lot of times it's not necessarily coming from a wind farm that only blows when the wind's blowing. So that would be my one comment on the environmental side. But in terms of why we have that in our portfolio, once again, for us, as you commented up front, Adrian, this is an Invico diversified income fund. So we're focused on generating income for our investors. And this is part of a portion of the portfolio that we have allocated to generate income. Because the way that we play energy, I would argue, is quite unique in that we're not buying equity of public companies. We're actually investing directly in the wellhead economics. So what I mean—
I'm going to slow you down. What is a wellhead? Because that is lingo that exists out west, like saying mud or some other oil and gas language that is just not used here. We're in Ontario. People don't even know that we have power plants. So what is the wellhead?
Fair enough. They don't like to talk about that either, right? It's just like, I just like to be able to turn on a light switch, and it's probably coming from a wind farm, right? So basically a wellhead is basically, I'm going to keep it real simple. You have a oil and gas equipment, let's keep it that high level, that basically you drill for oil and it comes out of a well. Not so dissimilar than back in the day when you lived on a farm, you had a water well, and that's where you got your water from.
So it is the literal part, though, where the drilling is happening. That's
exactly.
Okay.
So we actually, the way that we are participating in oil and gas is we actually own, and it is a bit different depending on whether it's in Canada and the US. In the US, much of the land where oil and gas is found is actually owned privately by farmers. And so basically what would happen is an oil and gas company would want to go drill for oil on somebody's land. And they'd say, hey, Adrian, I want to drill for some oil on your land. And you'd say, well, what's in it for me? And they would say, well, you know what, how about we form a partnership? And so you're a farmer, you're not going to operate it. They're going to operate. The oil and gas company's going to operate it, but we're going to drill this well and it's going to cost, pick a number, $1 million, and you're going to participate for 2%. So you're going to pay the cost of 2% of the cost to drill this well, and you'll get 2% of the revenues. And so you're like, okay, this is good. Then all of a sudden, knock, knock, knock on the door next month, we're going to drill another well. And you're like, okay, this is good. I'm going to participate. We got an agreement already. You continue to participate. All of a sudden, one day, Adrian, the farmer wakes up and he's like, whoa, wait a second. I'm not in the oil business. I'm in the farming business. I can't keep writing these checks to participate in these oil and gas wells. So but you own the land. So basically what happened is you decided, I'm just going to sell my ownership in this joint venture partnership I have with this oil and gas company. I'm going to sell it. And that's basically what we own. So the reason why we like it is because these agreements are very favorable to the farmer, because back in the day, they needed the farmer to participate to be able to drill any oil on their farm. The other nice thing is that you're participating right in the revenue. So you don't care, quite frankly, if it costs this oil and gas company a ton of money to do different things that they're doing internally, because you're getting the revenue right off that well, which is great. You paid your 2% of cost, you get your 2% well. So that's what I mean by when I'm saying you're participating right in the wellhead economics. So if that oil and gas company pays their engineers a ton of money, you don't really care about that, because you're getting the revenue right from the money that's generated from that well. So that's what we like about it, Adrian. It's very diversified. Once again, obviously being based in Calgary, we have an oil and gas team. They're a technical team. You need a technical team to do this strategy properly. We don't operate, so we're not actually, running the equipment. But you still need a technical team to be able to evaluate, because what happens is we actually own the mineral rights to a lot of these land positions. They go and drill additional wells. They come to us and say, hey, do you want to participate? So we have the right to participate, but not the obligation. So once again, you want to have the expertise to be able to say, yeah, this makes sense. We want to participate. Also, you need to have the expertise to be able to say to our investors, every year on an annual basis, we value that ownership in those lands, and we need to be able to tell people what it's worth. So that's also a big portion of what the oil and gas team do, are the technical work to provide it to the independent reserve engineers to say, this is what this is worth, and we can report to our investors.
Okay, that's great. I think that's a pretty good summation. We're running out of time. I want to ask you one final question. It's a little bit more broad-based about the industry itself. We have done in my business, we do a lot of work with the accredited investor space. So these, companies like yourself, where we're doing things through OM, we take the reduced liquidity, but we think we get a superior product, and the investment goes over a longer period of time. A lot of this, though, is trust, right? Trust in the open market is really augmented by the amount of liquidity that's available. So very high liquidity means that, trust is kind of got a low value, because we value things daily. We have a lot of reporting that's required. If you don't meet the reporting requirements, you can't be in the market, all of that. You guys, we have a much higher trust factor, which is nice that we get to have conversations like this. Recently, it's obviously been a big story, is Bridging Finance as a corporate financer in Toronto. They fired the CEO and his wife, who was the CIO. And, they were quite well known. They're $2 billion financing firm, handed over PwC. There was even more news today. I think they found that they deleted 30,000 emails. So it's very hard. Obviously, you can't predict fraud necessarily, but can you walk us through a little bit about, I don't know if you have a comment about that necessarily, but maybe give us a sense of who oversees you, and why is it that we trust you, and how do you reassure that trust to us? Do you mind giving us something on that?
Yeah, no, sure. Absolutely. I think you've touched on a lot of good points in that question, actually. So at the end of the day, the oversight that we have is quite frankly not dissimilar to the bridging management team in terms of they were registered with the Ontario Securities Commission. We are Invico Capital Corporation is the investment fund manager and portfolio manager to the Invico Diversified Income Fund. We are registered with all the applicable securities commissions across Canada. And to be honest, I obviously don't have any inside track or anything other than what you're reading in the media and what you can read. And I am a bit of a legal junkie. I love to read all the filings that come out. Obviously in this instance, the one thing I can point out is the Ontario Securities Commission is the group that put them into the receivership, which they did their job, obviously, in terms of that oversight that they're providing. Obviously, sometimes it's a little bit, better late than never, I guess, quite frankly, because these things take time and processes. I guess a couple comments I can make about the bridging situation, and as I said, I could only speak to what's obviously available in the public domain, is that there were a lot of changes within the ownership structure of the bridging finance entity. Throughout the Invico Diversified Income Fund itself has been around. We're coming up on our 8-year anniversary. There haven't been any management changes, ownership changes, or portfolio manager changes during the history of this fund. In fact, Invico Capital Corporation has been around since 2005, and outside of one shareholder change back in 2007, there hasn't been any change since then. So that would be one comment I'd make in terms of the continuity, I guess, with respect to the ownership structure, which a lot of the allegations, once again, nothing's been proven, but what's been in the media, the allegations center around the ownership changes at the management company level, which has not been the case with ourselves. The other thing I would mention is the transparency in terms of, like you said, getting on these types of calls and the different information that we make available to groups like yourself as advisors to us. Obviously, a lot of your clients are entrusting you to do the work. So we are always available. And I know you've called me lots of times to talk about different situations. We've been very transparent. As you just mentioned, one of the things that we pride ourselves in, it's never great to have a loan that you have to roll up your sleeves and get in there, but it's not all rainbows and unicorns. So one of the things for us is being transparent to our advisors. And if your investors want to hear about all the details, you're I guess, aware of what's happening, where we stepped in and taken position and taken control of the situation, rather than just say, everything's great, nothing changes, everything stays the same all the time. We do have fluctuation to our net asset value because every quarter we have to do our work to determine where things are at. And we are giving that information to the advisors to obviously work with their investors on.
Okay, thank you. I'm going to just offer if anyone wants to ask a question. I suspect we're not going to get any questions today. But Allison, was there anything you wanted to add on? Is there anything that you haven't had a chance to address that you thought that you should at some point today? Or, oh, I think we may have one person that has
Somebody raised their hand.
They raised their hand. I'm not sure what that means, actually. I think there should be a way to ask a Q&A. It's a button down there.
I think it's in the chat, right? In the chat.
Well, you can do the chat too. So I'll just open up the chat and say, 1 second. See if we can get a question out of our attendee. I think though, we'll just wait and see what he has to say, and see if he can get back to us.
You know what, actually, Adrian, the one thing I do want to mention, which I don't think we did highlight on, is things I do want. I guess a bit talk about our expertise of the oil and gas team, but we do have a team of 35 people. Our investment team is actually 10 large. That would include some of the oil and gas professionals. So we have a very diverse team in terms of industry experience and tenure here at Invico, which is really important, obviously, when it comes to underwriting lending situations or oil and gas opportunities. We have people ranging from, people that have been out of school for 3-4 years, all the way up to people that have 38 years plus industry experience. So it's a very diverse team. We have a lot of CAs on our team. They've been CFOs of publicly and private traded companies. So obviously when you're making a loan, those level of technical expertise is very important, but also the ongoing compliance is another important piece that I didn't touch on. Obviously you can make a loan, but then you need to obviously monitor your loans and make sure they're performing as expected. And if they're not, that you're following up and finding out what's going on, so that if you do need to go in and take control of a situation, that you're doing that in a timely fashion as well.
How much leeway does someone who's got a loan with you have before you're willing to jump in, or when you think it's necessary to jump in? I mean, you can have a month deviation and they're going to say, look, it's a 1 month thing. Is it 3 months? Is it the size of the deviation? Is it some combination?
I was going to say all of the above. Yeah. At the end of the day, with all of our lending positions, we carry what's called a 3-month default reserve. So basically it gives us 3 months to kind of work through things.
I will. So I think the question is, well, I finish your thought and then I'll say the questions for the benefit here. Yeah.
Yeah, so basically, at the end of the day, they would have reporting packages they have to provide on a quarterly basis. So we would never let it go longer than basically 2 quarters, and then we would be in that period we'd obviously be stepping in to make sure we're making actions. But all these are the situations where it is a bit fluid, obviously depending on what their circumstances and, as you say, the magnitude of it as well, and why it happened and whether it's repairable, I guess, from that perspective.
Okay, so the question is, and then if we have 30 more seconds, I'm going to ask you something about oil and gas. But the question is, how will higher interest rates affect the fund? And do you price future loans with I think the thought is of inflation at 5%. And I suspect the reason that 5% has come up is that in May, the United States, this was minutes before we got onto this call, Allison, was reporting that the inflation rate in May in the US exceeded 5%. So I'm curious to know, and it's not a bad question because there's a lot of questions about whether we're going to have, interest rates rise if inflation is going to be stronger than anticipated. What happens? What happens to the fund as rates go up? How long do the duration of your loans, and how quickly can you reprice them? And what will it do? I mean, you're already making about 10% after your fees are taken off. So please, what can we expect out of a future of higher interest and inflation?
Yeah, so basically all of our current facilities and historically everything that we've done have been fixed rate interest rates. So they haven't floated with any variation, which obviously can be positive and negative. That's just the way we've structured them. And we've structured them to be able to, I guess, service our investor needs. So I think the fact that we have fixed rates, obviously, if interest rates go up and down in the short term, it's not as impactful. I think the other thing that I would point out is that our experience has been fluctuating interest rates are more applicable or have been more directly driven to underwriting in the real estate space. I think right now, obviously, we're seeing a tremendous, obviously, with where we've just come out of the last kind of 6-9 months with interest rates at an all-time low. It has been challenging for us to place capital in the real estate space, candidly, because obviously, if they can borrow money at sub 2 or 3, depending on the size of the entity, they're not coming to us for loans, which is okay because we're diversified. So I think that's one thing that benefits us as well, is that we're very diversified. Interestingly enough, right now in energy, we're seeing quite a rebound, obviously, in energy, but none of the capital's flowing there. So groups that are, that we can run, investment decisions and have IRs north of 20%, it's not as sensitive to interest rates necessarily on the oil and gas side. So I think the diversified nature of our portfolio is very beneficial in terms of how we can price our loan facilities. And we do ladder, obviously, the maturity. That's one thing we didn't talk about. Our maturity is anywhere between 6 months to 3 years. So also we have some flexibility as things ladder out to be able to take advantage of the situation. But because of our fixed rate nature, we haven't really had historically any issues. We may look to, with these major swings that we've had in interest rate changes, we may look to add a component of our facility that could float. But that's something we have to model and obviously think through carefully.
It's probably worth pointing out as well that these are private positions. So this is not like a bond that's trading in the open market. So higher interest rates merely cost us money, but they do not change the price of the loan that we are invested in. Whereas in the open market, higher interest rates immediately, government bonds were off 4% this year to date, just because of that kind of thing. So could it affect the NAV though, when you're pricing out the actual value of the units that we're holding? Can interest rates have a downward pressure on the net asset value of the fund?
No, not the current positions in particular, because all of our interest rates are fixed. So they don't float at all. So it would not be impactful whatsoever to the NAV.
Okay. I've got one final question. Do you still have time for one more here? Because I appreciate that you've
absolutely
than I was expecting. Just on the oil and gas, I find that, as you point out, the Canadians on this side of the country are far more concerned to just make sure the lights go on. But the oil and gas business is a lot more complicated and nuanced than I think people appreciate. And I'm curious to know, yesterday we saw finally that the Keystone pipeline, I think is done and done now. It's no one's going to build it and it's not going to happen. I'm curious to know, of the energy working interest that we have, are they connected to that at all? What kind of price of oil do you need to keep your energy working interests valuable to the fund? When do they stop being valuable, I guess? And if something comes out after that, why don't you answer those things first, and then if I have anything left, we'll wrap up following that.
Yeah, for sure. So our first position in the energy working interest was on the U.S. side of the border, and part of the reason why we entered the U.S. side at that point in time was because of infrastructure constraints in Canada, which obviously infrastructure is something that is a very capital intensive portion of the industry, and also very timely in terms of you can't just decide today that you're going to build a pipeline tomorrow. There's a lot of permitting and public consultation and various things that need to go into building infrastructure. The area that we are based in the US, and we have expanded our position, it was originally just in Colorado. We now have assets in Wyoming, North Dakota as well. Those regions, none of those regions are infrastructure constrained. The other thing about those regions is they're very, I guess, in terms of drilling for oil and gas in those regions, I would argue it's what we call development drilling, i.e. we know we're going to find oil. It's not what they call in the industry exploration. It's not like, oh, let's go drill a well, see if we hit oil. That's not what the mandate of this fund is whatsoever. So that's why we focused on the US side of the border at the point in time that we did, and we've continued to add to our position. We've actually recently shifted back into Canada, and we actually did an acquisition at the end of 2020 that was based in Canada, and it was on the gas side. It's a very gassy portion of the portfolio that we added because we now feel that despite the what you just mentioned about the XL, there are infrastructure builds that are happening in Canada. The Trans Mountain pipeline, for example, is going on, some line extensions, those types of things that now we don't have the infrastructure constraints that we necessarily had in Canada at the point in time that we entered in the US. So those are one of the things that drive our decision is in infrastructure availability, in connectivity, because that ultimately drives your economics. Because if you can't transport the commodity, that's obviously going to impact your economics. So if my technical team were to listen to this podcast, which they probably never will, they would cringe if I were to give you an exact number in terms of what makes an investment decision economical. But suffice to say, because of the way that we structured the transactions, we don't get too fussed. The other thing I should mention, which you kind of touched on, is we don't price daily, right? So we're making investment decisions for a longer period in time. So if oil and gas goes up by $1 or $2, we're not freaking out because we're not a publicly traded entity. That's another benefit of being private. But we make investment decisions at a point in time, given not to get too technical, a forward strip that's kind of an average of experts in the industry and kind of how they see the foreseeable future. We do also, from a risk mitigation standpoint, on an as-needed basis, implement hedging strategies that we think are prudent at the time on the advice of our technical team. So to give you an example, back in 2020, as I'm sure you're aware, we did hedge some oil. Right now, we're fairly, balanced towards gas. So a larger portion of our portfolio right now, our holdings are gassy. So we actually did put in a gas hedge as well for this next period of time over the summer months.
So what does a hedge mean here? You're buying what? Future contracts at a price point?
Exactly. So we have supply that we need to sell. So we're locking in basically a floor on that, so that obviously we're going to get paid that. If it's more than that, that's great, but we won't take a number less than that.
Okay, that's great. Allison, I want to thank you for your time today. It is 2:55, so you've given me almost an hour, which is fantastic. If anyone has any further questions about Invico, please feel free to reach out to me directly, and I will forward questions on to Allison's support team. I want to thank Allison again for joining us. And next week, again, barring that we haven't had any change in schedules, we'll be joined by Edward Luce from the Financial Times, their chief correspondent for the United States, and author of the books In Spite of the Gods, The Strange Rise of India, Time to Start Thinking, and his most recent book, The Retreat of Western Liberalism. Allison, thank you very much for joining me. And we'll be releasing this on YouTube in a couple days. So thank you very much.
Thank you so much, Adrian, for the opportunity.
Cheers.
Bye-bye.
Have a great day. Bye.